Howdy, everybody. Welcome to Liberty Call. Today is Thursday, August 1st, 2024. Hope you're having a fantastical day out there in the interwebs. It's another sunny, hot day here in Colorado. We still got forest fires a little up to the north of Boulder. So anywhere along that range, we've got, well, the problem is you get these fires down in the canyons and then you get these winds and it just whips through. And hopefully we'll get some thunderstorms this afternoon, which should hopefully put most of that to rest. So thank goodness we got good firemen out here in these rural counties where we live. So anyways, all right. Well, if it is your first time watching Liberty Call, if you could do me a favor, give me some thumbs up, a like, share, subscribe, and follow, and press that notification bell. Markets were not in a good mood today. You would think yesterday, the Federal Reserve came out and said, hey, we're probably going to start lowering rates here in the near future. Everyone's eyeballing September as the time that's going to happen. And markets reacted positively yesterday, not today. All right, let's get into it and see how things turned out. Dow Jones was down 1.21%, 494 points. I think it was like 700 points at its worst, I think. S&P 500 down 1.38%, 76 points, closed at 5446. NASDAQ down 2.29%. 403 points, closed at 17,195. And if I missed it, the Dow Jones closed at 347. The VIX was up today, 13.51%. It's at 1857. Canada down 1.68. Brazil down 0.13 and Mexico down 1.28. In Europe, Germany was down 2.28%. The UK down 1.01. France down 2.14. Netherlands down 1.46. Spain down 1.9. Italy down 2.68. Switzerland up. It's the one bright spot in the Western Europe. It was up 0.29%, and Portugal down 0.7. Russian exchanges were split today. The MOEX down 0.21. The RTSI up 0.17. And the overnights, Japan, the Nikkei was down 2.62. Australia up 0.28. New Zealand up 0.98. In China, the Shanghai was down 0.22. Shenzhen Component down 0.92. China A50 down 0.71. DJ Shanghai down 0.37. Hang Seng down 0.23. And the Taiwan weighted was up 1.99%. All right. So like I said, ugly day. I mean, and it started in Europe, and I guess the contagion came over here and jumped the pond and hit us over here. So anyways, all right. Well, let's get into today's market recap. U.S. stocks slump as weaker economic data stokes recession jitters. Who's been saying that would be the real reason that the Fed would lower rates? It's not going to be just because rates are too high, because they're not. I mean, if they were like 10, 12%, I could see the bitching and moaning. But 5.5%. I mean, seriously, folks. God, I got an itch on my face. I trimmed my beard and everything, so there's probably like little hairs everywhere. I mean, I even took a shower afterwards, but it's just, I feel itchy all over after trimming this thing. So at least it's not, sticking out all over the place like it was before. All right, let's get into this. U.S. stocks fell sharply on Thursday as a series of economic data indicated a softening economy, dampening investor sentiment despite expectations that the Federal Reserve will cut rates next month. Next month is September. All right, weaker U.S. data. Initial jobless claims rose to 249,000 for the week ending July 27th, higher than expected. The ISM Manufacturing Index for July also came in below forecast at 46.8. This 16-month streak of sub-50 readings indicating contraction is the longest since the period surrounding the Great Financial Crisis. Excuse me. These reports heighten concerns about an economic downturn, even as the Federal Reserve is anticipated to lower interest rates next month. The 10-year Treasury yield fell below 4% for the first time since February, reflecting these jitters. On Wednesday, the Fed kept interest rates unchanged, but Chairman Jerome Powell signaled that a September rate cut might occur if upcoming economic data, including the non-farm payrolls due Friday, show progress on inflation and labor market cooling. The tech sector falters. Technology stocks declined alongside the broader market. Meta Platforms surged 4% following stronger than expected second quarter earnings and upbeat guidance, with investments in AI improving targeted ads. Deutsche Bank noted that Meta's AI investments would drive significant growth in capital expenditures in fiscal year 25. Qualcomm fell over 10% after the U.S. revoked one of its export licenses to is it Huawei? Huawei, despite the chipmaker posting quarterly results that topped estimates. ARM Holdings dropped 16% due to softer guidance despite better than expected quarterly results. NVIDIA fell more than 7%, parrying previous gains as investors awaited further insights from Intel's upcoming report. Apple and Amazon were also set to report on Thursday, which is today. And wrapping things up, Moderna and Eli Lilly have mixed fortunes. Moderna's stock slumped 21% after the company cut its full-year revenue guidance due to low EU sales and a competitive U.S. vaccine market. Conversely, Eli Lilly gained 3.5% after trial results showed its weight loss drug Zepbound reduced the risk of hospitalization and death for obese adults with a common type of heart failure. All right. Yeah, it's personally, I know those obesity drugs, I've seen a lot of people lose a lot of weight on them. They do slow down your digestive system, which can lead to some other issues. So probably fasting would probably be the first thing I would start with if you want to lose weight. Fasting, one meal a day, those sorts of things. Carnivore diet, things where you eliminate a lot of the sugars and carbohydrates out of your regular meal or meal plan. So I'd start with that first, and some exercise. Move around a little bit, folks. Alrighty, got some data here. Q2 productivity, the preliminary number. This was put together by Strider Elas, senior economist at First Trust. So let's see what he has to say. In the second quarter, U.S. non-farm productivity rose at an annualized rate of 2.3%, with output increasing faster than hours worked, resulting in higher output per hour. This better than expected productivity growth, along with slower growth in labor costs, bolsters the Federal Reserve's confidence in their disinflationary outlook. I really haven't seen much, disinflationary outlook as they contemplate rate cuts in September. Unit labor costs slowed to a 0.9 annualized pace in Q2 from a revised 3.8 in Q1, showing only a 0.5% increase over the past year and the smallest gain since before the pandemic. While inflation remains elevated, real compensation per hour grew at a 0.4% annualized rate in Q2, but remained unchanged over the past year. In manufacturing, productivity increased at a 1.8% annualized rate in Q2. Despite this, productivity in manufacturing is only up 0.4% over the past year and had fallen 0.8% the prior year, suggesting that the Q2 increase may be temporary. Government intervention and resource allocation is noted to harm long-term productivity. On the employment front, initial jobless claims rose by 14,000 to 249,000 last week, and continuing claims increased 33,000 to 1.877 million. Additionally, ADP's measure of private payrolls rose by 122,000 in July, below the expected 150. For the upcoming government report, a non-farm payroll gain of 197,000 is estimated, with the employment rate expected to remain at 4.1%. Overall, the positive productivity data and moderate labor cost growth are seen as supportive for the Fed's potential decision to cut rates in the near future, despite ongoing inflation concerns and mixed employment signals. So it's sort of good news. All right, next up, a little more data. The July ISM Manufacturing Index. This was put together by Nate Guernsey, also of First Trust. All right, U.S. manufacturing sector continues to struggle, as evidenced by the latest ISM Manufacturing Index, which fell to an 8-month low of 46.8 in July, missing consensus expectations. This marks the 20th contraction in the past 21 months. Of the 18 major manufacturing industries, only 5 reported growth, while 11 reported contraction and 2 saw no change. Both the output and demand contributed to the decline, with the production index dropping to 45.9, the lowest since the COVID-19 lockdowns, and the new orders index falling further into contraction at 47.4. Companies facing weak demand have been reducing their order backlog, with that index staying in deep contractionary territory at 41.7 for 22 consecutive months. Survey comments indicated dwindling backlogs and resultant cost-cutting measures. The employment index also saw significant weakness, plunging to 43.4, the lowest since the lockdowns, with only 2 industries reporting an increase in employment and 13 reporting declines. This downturn in manufacturing underscores broader economic data signaling a slowdown in growth. Continued weakness in the sector is expected through the second half of this year, influenced by the aftermath of extensive government spending during the COVID-19 years and the lagged impacts of a decline in the M2 money supply from early 22 to late last year. In other economic news, construction spending declined by 0.3% in June, driven by large drops in home building and commercial projects. The Case-Shiller Index increased by 0.3% in May, up 5.9% year over year, while the FHFA Index remained unchanged in May, but increased 5.8% year over year. Pending home sales rose by 4.8% in June after a slight 1.9% decline in May, suggesting that existing home sales will likely see a slight increase in July. All right, so that is all the data. Got an article here from Mr. Brian Westbury and Robert Stein, Deputy Chief Economist of First Trust. It's titled "September is Live." It's kind of his commentary on the Fed meeting over the last couple of days. And then down here, they have some text directly from Chairman Powell's statement yesterday. So we'll go ahead and read that in its actual form. So, all right, let's jump into his summary. With inflation moderating and job growth weakening, the Federal Reserve is preparing markets for potential rate cuts as soon as September, though no commitments were made at the last meeting. The Fed's statement reflected these changes by noting softening job gains, higher unemployment rate, progress on inflation, and a focus on risk to both sides of their dual mandate. However, the Fed maintained that it does not expect to reduce the target range until there is greater confidence that inflation is moving sustainably towards 2%. During the press conference, Fed Chair Jerome Powell indicated that if recent data trends continue, it may be appropriate to cut rates at the next meeting. He acknowledged that a strong majority of Fed members supported not moving rates at the current meeting, but confirmed that September rate cuts are on the table if favorable data persists. Powell also highlighted that the Fed now sees the labor market as less an inflation risk and more of a potential downside risk, which could prompt policy easing. Despite growing confidence in easing monetary policy, the Fed is cautious and awaiting several key inflation and employment reports before the September meeting. The Fed's past mistakes, such as ignoring the growth of M2 money supply, ignoring it, they did it. I mean, they're the ones who printed all the money. I have to believe. I mean, they could have spoke up at any point during the summer of 2020 and said, "Hey, Congress, don't do this. This is a really bad idea." No one spoke up. All right. The money supply and misjudging inflation trends have led to their current cautious stance. They have consistently been off base with their forecasts, leading to reactionary approach to stubbornly high inflation. The expectation is that the Fed will cut rates twice later this year in September and December. However, these cuts are likely to be accompanied by a slowing economy, higher unemployment, and moderate progress on inflation. The effects of previous money printing, excessive government spending, and corporate overhiring are beginning to manifest, complicating the Fed's path forward. All right, so let's get to here. All right, so here's the text from their statement. Recent indicators suggest that the economic activity has continued to expand at a solid pace. Job gains have moderated and the unemployment rate has moved up but remains low. Inflation has eased over the past year but remains somewhat elevated. In recent months, there have been some further progress towards the committee's 2% inflation objective. The committee seeks to achieve maximum employment and inflation at a rate of 2% over the longer run. The committee judges that these risks to achieving its employment and inflation goals continue to move into better balance, meaning it's getting there. It's very slow. The economic outlook is uncertain, and the committee is attentive to the risks to both sides of its dual mandate. In support of its goals, the committee decided to maintain the target rate for the federal funds rate at 5.25% to 5.5%. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target rate range until it has gained greater confidence that inflation is moving sustainably towards the 2% target. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed. The committee is committed, nice, to returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee assessments will take into account a wide range of information, including readings on labor market conditions, inflation pressures and inflation expectations, and financial and international developments. Was that exciting? I know. Let's put this into ChatGPT and see what summarize this into, 50 words. Let's do that. Summarize into 50 words. Let's see what comes up here. Economic activity continues to grow steadily with moderate job gains and low unemployment. The inflation has eased but remains elevated. The Federal Reserve aims for a 2% inflation and maximum employment, maintaining the federal funds rate at 5.25% to 5.5%. Rate reductions are unlikely until inflation trends downward. Treasury holdings reduction continues. So all of those words could have been just said in 2-3 sentences. It's amazing. All right, good stuff there. So basically, the Fed is doing nothing right now. It's kind of like Goldilocks. This is too hot. This is too cold. This one's just right. So it's kind of meh in the middle right now. We're not, skidding towards catastrophe yet. But things just aren't great. I mean, we just went through a couple of different, data articles on, production and so on. And, things are not good. I mean, you've had contraction for, the better part of 2 years. The yield curve has been inverted for 2 years. Everything is 40% more expensive than it was 4 years ago. So yeah, I mean, if you think things are great, let me know. All right. One last article here. This one's from Zero Hedge. A $1 million starter home is now the norm in 237 cities. The housing market in the United States is experiencing a significant increase in starter home prices, with hundreds of cities now seeing prices at or above $1 million due to housing shortages. According to a report from Zillow on July 25th, the number of cities with typical starter homes valued at $1 million have risen to 237, a record high, up from 84 cities just 5 years ago. The majority of these cities are in California, followed by New York, New Jersey, Florida, and Massachusetts. The New York City metropolitan area leads with $1 million starter homes in 48 cities, followed by San Francisco, which is made up of 44 cities, the LA market, which makes up 35 cities, San Jose has 15 cities, and the Miami and Seattle, each 8 cities each. The spike in these prices is attributed to a worsening housing shortage during the COVID-19 pandemic, with inventory of homes in June significantly lower than pre-pandemic levels. Could also happen to be that people didn't want to live in blue states, which were locking them down several years ago, which you had a massive migration from the West Coast and from the North down to Texas and Florida because they were less punitive and didn't have all the silly rules. That's part of it. I mean, that's a major part of it. Yes, interest rates going up, from 0 to 5.5 has had an effect, because the higher the interest rate, the higher your payment is on a mortgage, which, unfortunately, keeping rates at 0 from 2009 to 2016 pushed home prices up and up and up and up and up. And, unfortunately, that pent up inflation has caught up with us at this time. All right. Where was I? High mortgage rates have discouraged homeowners from selling, tightening the housing supply and keeping prices elevated. Zillow anticipates a more balanced market soon as rate lock effects ease and more homes are built, potentially increasing inventory and giving buyers more negotiating power. However, experts like Rick Arviello and Jessica Lutz are skeptical that increasing inventory will lower prices, citing persistent demand and limited supply. Well, maybe if you got rid of the 50 million illegals in the country, that would free up a lot of housing. The national cost of a typical starter home is now over is now over $196,600, which is still considered affordable for median income households. However, starter home prices have risen by more than 50% in the past 5 years, causing many prospective buyers to delay purchases. The median age of first-time buyers was 35 last year, up from 34 in 2019. Political uncertainty and high mortgage rates are additional factors affecting buyer decisions. Some buyers are waiting for the outcome of the upcoming election before purchasing, probably not a bad idea, while others are concerned about the economy and housing market stability. The Federal Reserve's interest rate decisions will also play a crucial role as mortgage rates remain more than double what they were 3 years ago. Elevated interest rates will continue to impact mortgage rates, making home purchases challenging for buyers. All right. Well, that's everything I had for today. So if anyone needs anything from me, please go to dsafinancialgroup.com. What am I saying? Go there, get all your financial needs taken care of. All right. Well, I hope everyone has a wonderful evening, and I shall talk to all of you again next time. Adios.